Welcome everyone. My name is Péter Mészáros and this is the Financial Fitness Channel. As you might know, this channel contains mostly Hungarian material, but today I have the honor to talk and have a discussion with Professor Steve Keen. And if you don't know anything about Professor Steve Keen, then he is an Australian economics and author, and he's also a professor in London. And the two, I think, most well-known books of you is Debunking Economics and Can We Avoid Another Financial Crisis? So very good books. So if you want, you can read them. And today, our topic is debt, because I hear it from everywhere that we have a huge amount of debt, households also, and government. So let's stick first to the households. Why is it a huge amount of debt problem?
Well, you've got to go back to why debt actually matters in economics to begin with.
Yes.
And that is a point of contention in economic theory immediately, because neoclassical economists who dominate the profession argue that credit plays no role in aggregate demand. They leave it out completely. And if you look at, for example, Ben Bernanke and his essays on the Great Depression, he rejected Irving Fisher's debt deflation explanation of the Great Depression on the basis that what he called pure redistributions should have no significant macroeconomic effects. So he completely rejected, without looking at the data, Irving Fisher's argument that a collapse in credit, which is the rate of change of private debt, caused the Great Depression. Now, when you look at what that belief is actually based upon, they also believe that banks do not create money. They believe that banks are what they call intermediaries, financial intermediaries. So they find a person who's a saver, and they find a person who's a borrower, they introduce the two, and they charge a fee for the service, but they don't actually create any money or any debt, and that is garbage.
Yes,
it has always been wrong, but they've stuck with that belief because it suits the remainder of their theoretical apparatus to leave banks out of the picture. And it's become almost an article of faith for them that banks play no role in macroeconomics. I'm part of a rebel group of economists which have been arguing for 60 years that this is wrong. And finally, in 2014, after the financial crisis, a number of central banks came out and started saying, yes, the rebels are right, the mainstream, the textbooks are wrong. They didn't quite say it that precisely, but they did say the textbooks are wrong. And they say banks do create money, banks do, rather than banks being intermediaries, they're originators of money and debt. So I call my approach to that bank-originated money and debt, or bond. And that is a far more realistic model of how banks actually operate than loanable funds, which is the textbook model that people like Paul Krugman promote even after the central banks came out and said the model is wrong. So that's the prelude. And the reason it matters, and this is also not accepted in conventional theory and even in non-orthodox theory, if you go shopping, your spending is the sum of your potential spending. It's the sum of your income plus your credit that you take out over a year.
Yes.
Okay. Neoclassical economics, because it argues that if you lent money, it must be somebody else who lent it to you, and therefore their spending power goes down, yours goes up, they ignore it. When you look at the aggregate level, rather than individual, knowing that credit is part of that credit is created by banks, aggregate demand is the sum of the turnover of existing money plus credit, which is the change in private debt. Now, when private debt is small, that change in private debt will be also small, certainly relative to income and relative to the turnover of existing money. So it doesn't matter much when private debt levels are low. But the higher private debt levels get to, the more that change in debt is a significant contributor to aggregate demand. And in the case of the American economy, for example, and I'll give you these numbers just by glancing at my computer over here, that began in the early post-war period. Private debt was about 40% of GDP, and credit, which is the annual change in private debt, was between 2 and 6% of GDP. by the time the financial crisis hit, it was 160. Debt was 160% of GDP, and the annual change in debt, which is credit, before the crisis began, was 15% of GDP. It fell to -5.
So it's much more.
Much larger, and the volatility. Credit changes much faster than income does. You're very unlikely to get a pay rise of 15% in 1 year, unless you're a CEO. But if you're quite able to take out a level of new debt, which is equivalent to 15% or 30% or more of your income, and in the aggregate level, that's why I refer to the change in debt to the level of GDP rather than to debt itself. In the American case, the change in debt was an enormous contribution in a positive sense before the financial crisis, which gave us the subprime bubble and all that sort of stuff. Yes. And then when it collapsed, massively negative. A 20% turnaround in terms of GDP in a matter of 3 years.
And can I say, is it really wrong to say that the credit or the debt issued by the banks, the commercial banks, is private debt, privately created debt?
That's correct.
That's correct. Yeah. Okay. And is it correct if I say that because we have too much debt as households, as people, normal people, average Joe, then we don't save enough? And I know that one person's liability is another person's asset, but as households we don't save enough, and we cannot invest enough, or not nearly enough. It should be, and the economy cannot grow as fast as they should, because we have just too much debt, and our resources are spent on financing our debt. Does it make sense?
It's reasonably correct, but there's some errors in there, so I want to unpack it, because in fact, because our private debt levels are so high, we're trying to save too much. The reason being, we're trying to pay down our levels of debt. Yes. So the way we do that is we try to spend more slowly, accumulate more money, and then use that to pay the debt off. Now, this is where one of the paradoxes of macroeconomics comes in, because individual saving means that their expenditure is less than their income. Yes. Okay, and they try to increase the gap by spending less, while hoping their income will remain constant. So an individual can save by spending less than they earn. In the aggregate, because your spending is somebody else's income, expenditure and income are identical. And what that means is, in the aggregate, savings is zero. Okay, so if you're trying to save money, somebody else must be dissaving precisely as much. That I'm leaving outside the question of creation of money, but if there's a fixed amount of money in the economy, and you save more of that money, meaning your expenditure is less than your income, in the aggregate, the rest of society must be in the opposite situation to precisely the same extent.
Okay. Zero-sum game?
Zero-sum game. Okay, because it's flows. If I buy your phone off you for €200, okay, I give you 200. My account goes down by 200. Yours goes up by 200. The sum is zero. Okay, but just because you're matching flows against each other. So in the aggregate, the sum of all flows in that sense is zero. And if you are saving money by spending less than your income, you actually cause, if you're the only person who makes that decision, you cause the rest of society to dissave. Okay, so when you then say, well, what encourages us to save? Often it's the fear of too much debt. We have a large amount of private, now talking individual, carrying a large amount of debt. Your response to that is to spend more slowly. And what that means is, at the individual level, yes, you can save that additional money and service your debt. But at the aggregate level, income falls. Okay, your attempt to save money at the individual level becomes a fall in income at the aggregate level. So that's one of the paradoxes. By trying to save money, because we're carrying a large amount of debt, we actually reduce the turnover of money, which reduces GDP and increases the debt burden.
It's not what the government wants. They want to increase our spending.
Yeah,
and it's also the reason then why the velocity of money is slower.
The velocity of money is slowed dramatically. If you go back to there's actually a very good measure in America called money of MZN, money of zero maturity. Okay, and one of the indices they'll maintain is the velocity of money of zero maturity. and that up to about 1965-70, that was running about 1.8, value of 1.8, meaning the money in the economy turned out about 1.8 times per year. Then when you had the period of high inflation, fairly obvious reasons, your money was falling in value, it was worth your while to spend more of that money. So the velocity actually increased to about 3.5. Then we had the Volcker recession, massive increase in interest rates, dramatic fall in economic activity, and the velocity of money fell from 3.5, not just back to 1.8, but it is now down to about 1.2 or 1.3. So in that sense, the turnover of existing money is generating less GDP now, far less GDP than it did back in the 1950s and 60s.
Okay. And it's also that part of this is because I think, but you will tell me, that the government supported also our debt to have more debt. They supported the housing.
Yeah.
Also, it leads to a bubble, but they supported me, for example, to buy a house. And we are now in Amsterdam, so you know that in the past years, the house market in Amsterdam, it elevated more than 10% a year. So it's huge, and also this privately issued debt is creating now this bubble, and so it is now a disadvantage for the government to support, because they supported the housing market, because if I buy a house, and many people buy houses, then we will also need more paint, we will also need more furniture, so it boosts the economy. But now, because we have so much debt, it is now a disadvantage for the government. So what do you think about the idea that at some point the government would have to see and recognize that supporting the housing market, it's not more paying off. So it is not more good for the government. So they should slow it down, and eventually they could stop it and reverse it. For example, by higher taxes. So, what do you think? Is it a possible solution for that?
No, because politicians benefit by being seen as someone who oversaw a boom. Okay, and if you encourage more credit, when you first do it, if you encourage people to take out more debt and they spend that money that they borrow, then that gives the economy a stimulus.
Yes.
That's the change in debt is actually a stimulus. The negative side is you have to pay interest on that debt. So the overall benefit is the change in debt minus the interest rate times the level of debt.
Yes.
Okay. Now, as you drive the level of debt up, the rate of that product of the rate of interest times the level of debt gets to be bigger and bigger.
Yes.
Okay. So you get a drain on the stimulus. The stimulus gets less effective the higher the level of debt gets to be. You finally get to the point where the rate of change of credit can be less than the interest on the level of outstanding debt. And rather than continue to stimulate the economy, it actually pulls the economy backwards. Now, we've got into that situation by encouraging this level of private debt over time. And one of the reasons it's happened, it should be obvious that this is a problem. It's not obvious because conventional economic theory teaches people that private debt doesn't matter. They become professors of economics and economic bureaucrats, and they might collect the data on private debt, but they pay no attention to it. So we've been blindfolded into it. Now, while the stimulus was working, while the credit was bigger than the servicing cost, then you could have a booming economy, and that looks great for a politician.
That's what I wanted to talk about, because a politician is caring about people, but what he is really caring is the re-election. And people, as everyone is smart, but as a population we are not smart.
I think my analogy often is
and-
between humans and ants. Humans are individually smart and collectively stupid,
Yes.
and ants are the other way around, individually stupid and collectively smart.
And we would like to spend more and more, and especially because we see that if I spend and buy a house, the price will go up. And we can talk about it, what the real cost of the housing prices is. We eventually get a high debt level, and as you say, also the financing of this debt it costs then more.
Yeah.
But what we then do, and politicians do, they don't stop with this behavior, but what they do is they lower the interest rates, so the debt burden, financing this debt, will be less and less painful. And this is what we had in the last multiple cycles, actually. So then we have lower cost of financing this debt, but then what we do, we continue with this behavior, with this bad behavior, and we take even more and more debt. So then at the end it has to stop.
You're trapped. You reach the point where you simply can't take on any more debt. And so the potential positive benefit of credit is gone from the economy. And because, for most of the history, because credit was part of aggregate demand, if you suddenly have credit not being part of aggregate demand or even being negative, then your economy is going to grow more slowly. And what you can see over time, is that's particularly in the American data, the rate of growth of the economy slowed down from an average of about 5% per year in real terms to about 2% now, if they're lucky.
Yes.
So this is, it becomes the bigger you let the level of private debt get, the more of it's a burden on the economy, even with low interest rates, because people, when they look at what they individually have to service, a household has to imagine that they can pay back the debt they've taken out in their lifetimes. And what that means is you look at, taking on 3 and 4 and 5 and maybe even 10 times your income as a level of debt, even with a low rate of interest, because you've got to pay that debt down over your lifetime. You become terrified by it, and your response is to spend less. So in fact, the turnover of existing money falls because of the increase in the private debt level, and everybody is, constipated financially, fundamentally, because there's too much debt in the system.
And it is the last day of October 2019, and now we know that the Fed cut interest rates again. So the inflation is about 2% or above, and the interest rate is 1.5%. So in real terms, it is already negative. And so there we are. And we cannot go back because who would support this idea of paying? Nobody. So it's very bad. And what about the government debt? It's also huge and growing. I don't know how to count the $1 trillion for example, in America.
Government debt, for a start, is lower than private debt. This is people
compared to the GDP.
Compared to GDP, and really in absolute terms as well. But because economists have made us obsess about government spending, and here this is the opposite situation. They ignore private debt, which is wrong, and they obsess about government debt, which is also wrong. So if you look at, for example, Robert Barrow, who is the conventional economist who gave us the idea of what they call Ricardian equivalence. And what this was a stupid argument, but stupid arguments don't get blocked by referees in mainstream economic journals. The stupid argument that if a government borrows money now, it must repay that in net present value terms in the future. Now,
is it like that?
No, not at all. Because if you take, for example, if you take a look at the level of government debt in America, that has ranged between as high as, I think, almost 200% of GDP, as low as about 30-40% of GDP since the post-war period. It's never gone to zero. And the government, if you have a growing economy, then in a growing economy, if you want the government to be a consistent percentage of the economy, just to sustain the percentage, then it must be expending more than it gets back every year if the economy is growing. So this idea that it should be set to net zero, so a change of government debt Like if the government borrows money now, it must repay the same amount precisely in net present value terms sometime in the future. If that argument is sustained, that means that over time, if the economy is growing, the government shrinks to zero.
Mm-hmm.
Now, neoclassical economists are often closet anarchists. They want to get rid of the government completely. Okay, I don't know how many of them are actually conscious that this would be the end product of that idea. Barrow, I imagine, is quite conscious of that. A lot of them simply don't, because they think in static terms. They don't understand reasoning in a dynamic sense.
Yeah.
If you think the economy has just got a constant GDP, then the idea that debt taken out now should be matched by repayment of precisely the same amount in net present value terms in the future, then that would make sense. But if the economy is growing over time, that does not make sense at all.
Yeah. And it's also that it's partially what we do is MMT, right? Modern monetary theory, in smaller terms already, or in the last 10 years, because what we do is we have budget deficit, and it's no problem because if the economy grows enough, then we grow out of the debt. So this is very similar to modern monetary theory, right?
Well, yeah, in a sense.
In a sense, and it's a small scale, but we do this already. In present value terms, this debt will be never repaid, because it is. Am I right? Because it cannot be. It just cannot be, and partially also that it doesn't also have to be, because we just have to roll over this debt and finance it.
Well, the point that I come back to is that general principle that the aggregate level of savings is zero. Okay, because if you divide the economy into three sectors, it doesn't matter what the three sectors are, then the saving by one sector is matched by dis-savings by the other two, because of that nature of how you account for the flows. Now, if you have if people are actually trying to save money, so let's say it's the private, the private sector, the foreign sector, and the government. That's the way you divide the three sectors. Okay, if the private households are trying to save money, and let's say your foreign sector is in balance, then the savings of the private sector will be dis-savings of the government. Equally, the opposite applies. If the government tries to save money, then that savings will be the dis-savings of the private sector.
Yes.
Okay. Now the question is, can the private sector afford to dis-save? No, because if you dis-save, one or two things happen. Either your income goes down, that mechanism I mentioned before, or you can supplement that fall of your money supply, because the government's taxing you more than it spends on you. It's taking more money out of your bank account than it's putting into your bank account, so your bank account's going down. Now you can respond to that by borrowing money from the private banking sector. And when you do that, of course, your money will then increase, but so does your debt, precisely as much. There's no net creation. So the only group that actually afford to continuously dis-save is a group that happens to own its own bank. Now, the only institution in society that owns its own bank is the government. So, in that sense, the government can afford to dis-save, which matches what the private sector is trying to achieve in terms of saving, and then that dis-saving by the government turns up as government debt. But that government debt is very different to you and me having a debt. If I owe a debt to a bank or to another individual, they have a claim on my future income sources. If the government effectively has this debt, it owes the debt to its central bank, okay? And the central bank can finance that indefinitely. There are all sorts of controls on who that government debt can be spent to, but fundamentally that change in government debt is equivalent to money creation by the government.
That's why I said Alan Greenspan that the US has debt, but it cannot default, because US can print unlimited amount of money, so the chance of default is zero.
It has a limited amount of US dollars.
Yes,
yes, because it creates US dollars.
So they cannot print euro or other currencies, but if they have debt in their own currency and they are in control of this currency, then they are just fine. That's the idea. But can the government print just unlimited amount of money, or to repay its debt?
No,
what is the problem with that?
The government, I mean, for example, let's take the British economy and what they call the if you've been to Britain, you know that in Scotland
Yeah.
they have their own banknotes.
Yes.
Okay.
Yes.
Now those banknotes are backed by what are called titans, so that the Bank of England lets these Clydesdale Bank create notes, so long as the number of notes that are created are no more than or are equivalent to the value of what they call titans, which are sheets of paper held at the Bank of England with a face value of £100 million. Okay. Now, if they want to produce another £100 million worth of Scottish notes, they print another one of these pieces of paper called a Titan with a face value of 100 million. Can you get them from the bank? No. Could you spend them? No. But they simply balance the money creation by the Clydesdale Bank, creating Scottish banknotes, which are equivalent to the pound. So the same capability exists with the government overall. It doesn't have to balance what is creation of money by debt. It issues bonds. We call them debt, okay?
Yes.
But they're very, very different. If you and I issued bonds, we couldn't spend any money until we'd sold some of those bonds. Now the government issues bonds, and as soon as they're passed by Parliament, the Treasury, the central bank treats the Treasury as having the funds required. And then when what's normally done, the Treasury will sell those bonds to the financial sector. They're almost always oversubscribed. So there's no technical problem in them doing that. If it's not oversubscribed, they can do effectively, through open market operations, the Bank of England can buy those bonds back from the private financial sector until such time as they are fully subscribed. So there's no limit to the capacity for the government to do that. The limit is what is the impact of all these behaviours on the macroeconomy. Is there underemployment? Is there inflation? Is there a balance of payments or deficit? Those are the issues. So it's the impact of the government money creation that matters, not whether it can or can't create the money in the very first instance.
It can.
It can.
But
yeah.
at the end, it could lead to inflation.
Yeah.
And also, that's the problem with it's not the problem, but it's the limit of modern monetary theory as well.
Yeah.
And then they should do something different. The amount of GDP produced based on $1 of debt, government debt, is shrinking.
Or is any form of debt is shrinking.
Yeah. So that is also a problem, or
well, it's
less effective.
It's a symptom.
Yeah.
It's a symptom because my basic proposition about demand in the economy, and it's looking at a private sector only, it's the turnover of existing money plus credit, which is change in debt. Okay. When you include the government sector in there, it's also government spending minus government taxation, depending partly on how it's financed, but that's your total level of demand in the economy. Because we've been ignoring private debt economically, in my opinion, what we should do is set a target for private debt levels and a target for credit, just like we do a target for inflation and a target for the unemployment rate. They're just as important, if not more important, than the inflation rate as a target for the economy. But because we don't, that level of private debt has increased dramatically. In the American case, it's increased by a factor of 4 over the post-war period. It's much worse in other countries in terms of the increase in the level of debt. Given that increase in debt, the rate of turnover of existing money has fallen, so you're getting less GDP out of existing money. And because we're now in a post-crisis period where people are no longer borrowing money on the scale they did before the crisis, credit-based demand is also low. So you have a whole range of problems caused by the level of private debt.
Yes, and it was your data, and it was a brilliant graph. I will put it on the video.
Yeah.
That in the last crisis, 2008, this private level of debt, the level of private debt, it decreased until a certain amount, but it's far not enough.
Yeah.
And it was not enough. This crisis was not enough to bring that down to a level which could be healthy, let's say. And what I wanted to, something just came into my mind, but I just forgot. And that, when we look at it, consequences. Yes, and the one thing I just remember is that if I it is if I look at this data, how much GDP you can create from that.
Yeah.
It's not in any country good, but in the US it is the highest. So in that respect, I think the US is relatively to the other countries, for example in Europe, Japan, China, it is more healthy relatively, and I think that this will cause that in the future the dollar will keep its strength relative to the other currencies. What do you think about that?
Well, and the American currency is strong partly because America is was the world's largest economy.
Yes.
Also because it's the currency for international trade. So that gives it, you have demand for American dollars, even if you don't have a demand for American goods. And that's given American financial sector immense power, but it also means the dollar is overvalued.
You say devalued.
Overvalued.
Overvalued.
Okay.
Now, and will it be devalued with time? So one solution, but we can talk about it now, that how to solve this huge amount of debt is currency devaluation. Is it a possible solution?
No, because only currency devaluation is actually a problem. Because of your currency, if your debt's denominated in your own currency, then a devaluation or otherwise doesn't matter. Or it'll change your export revenue. Okay, but it won't change your debt ratio. If the debt's in a foreign currency and you devalue your own currency, then it makes your debt level worse. So
because it will cost more and more money
in foreign money, to
pay this in the foreign money.
So I think this is what very, very good work by an American philanthropist called Richard Vague has identified this. When you have too much private debt, that is what almost always causes economic crises. Every crisis that he's looked at over the last century, about 150 of them around the world, have all been caused by excessive levels of private debt. So it's the causal factor. Then in the aftermath of the crisis, you're saying after the 2007, we haven't paid debt down enough. But you say, how has that debt been reduced? People often think you can grow out of your debt. No, it's never happened. You can grow out of government debt as it happens, because government debt doesn't have the same negative impacts in terms of having to be repaid as private debt has. But every country that's had a private debt crisis has failed to grow out of that crisis unless they're in the bizarre situation of someone like Saudi Arabia, where increasing your export prices can dramatically increase your export revenue. So when the OPEC put up oil prices by a factor of 4 back in 1973-74, and then by another factor of 4 in 79-80, those massive increases in the price of oil enabled the Middle Eastern countries that were major oil exporters to pay their debts down. But that's the only situation where an economy has managed to grow out of debt. In every other case, the only way to reduce that debt has been to write the debt off.
That's the other solution. And I also wanted to ask that we can devalue our currency compared to other currencies. But these are all fiat money. And what if we say we have, if I stick to the US, officially we have 8,000 or something like that, 8,000 tons of gold. And what if we say they've done it before multiple times, that we say that, okay, gold, we price gold now at $42 or something, but now it will be $1,000. So we have something, and a different anchor than a currency, and then we devalue our currency against this anchor. And they've done it before.
They've done it before, but that was we had a gold standard at the time.
That's true.
And at that point, gold was $35 an ounce, and that was written into the Bretton Woods Agreement. And then, of course, the reason America was in trouble over that wasn't so much its foreign debt situation, it's the amount of its own currency that was circulating in other countries. So de Gaulle, then the president of France, threatened to take the accumulated American dollars that France had accumulated out of its trade surplus with America and take that money to Fort Knox and demand the golden
Go
Fort
back.
Knox.
Yeah, yeah.
That's what actually forced Nixon's hand. A couple of other factors, that was the major one, to break with the gold standard. So devaluing in terms of a commodity works if you have a commodity-based standard, which we no longer have.
That's true.
Okay, so there's like you could try to sell that 8,000 tons of gold. I think the last ton would sell for a lot less than the first ton, and that would again reduce the effectiveness of what you're trying to do. I said the government doesn't need to pay its debt down when the debt's denominated in its own currency. What we need instead is to reduce private debt and use whatever capabilities we have to do that, and that can include the government's capacity to create money.
And so you see this as a central problem, the private debt.
Yeah.
And this could lead to a crisis eventually if this goes further, because at a certain point, we don't know when, but it has to stop because it will be too much.
Well, if you look at the interesting case there is Japan, because Japan was the very first country to have a debt crisis after the Second World War, and that happened back in 1990. And at that stage, private debt in Japan peaked at about 225% of GDP. It's since come down to about 170%, but that whole period has been a period of stagnation for the Japanese economy. Japan's managed to weather that because of demographic change and because it's a very cohesive, single nationality country fundamentally. And it's also got a huge export surplus. So with the export surplus, you can actually use that effectively to pay its own private debt levels down. So it's done that successfully. But every other country in the world followed the same mistake of Japan and let a private debt bubble happen. And now they're all in that same aftermath of too much private debt. And because governments actually think it's a good thing to encourage debt, then we rather than getting rid of the cause, we're trying to encourage it even further. The only real solution is to say, look, banks created too much money, lending for often Ponzi scheme reasons, because bank lending creates house price bubbles.
Yes.
That whole thing has caused the economic and financial crisis. The only way out is to reduce it, and we could use the government's money creating capacity, which they demonstrated through quantitative easing. We'd use that same capacity to create money for the household sector to eliminate household debt.
That would be the modern debt jubilee.
Modern debt jubilee, yeah.
And you also told earlier that it's a very bad thing to pay off my debt if you don't have a debt.
Yeah.
And I have, and it's not fair to pay my debt, and you end up with nothing. And that's why both of us would get money.
The idea is to per capita.
But I have a problem with that, because then I can pay back my debt and you get money, but probably you have to spend this money on buying up stocks or something like that. Or even if not, but then part of this money that you have, but you get for free, you will spend it. And then, for example, if you buy stocks, then the stocks will be even more overvalued than today.
This is why I think it has to be a sophisticated program. It can't just be a case of creating government money and throwing it into the wind. Which is what, like the Australian government did that back during the global financial crisis. They gave everybody who'd paid their tax roughly $1,000 rebate. Okay, and that stimulus boosted the economic activity dramatically. Of course, a lot of it went into imports, importing flat screen TVs. Okay, but that did work. But that was done without any controls. Now, what I would be doing is a whole range of things. First of all, I'd say everybody gets the same amount of money. So that levels the wealth playing field, because the wealthy don't get more than the poor. Everybody gets the same amount of money. If you are in debt, you must reduce your debt, or it's used as a debt offset. If you're not in debt, you get a cash injection. Now, the cash injection, if you had an economy which needed an economic stimulus, then you could use that as part of the stimulus. What I would prefer to do is say, well, it's actually corporate debt is also too high in most countries. And quantitative easing boosted the value of shares, which helped out those who own shares, disadvantaged those who don't. So I would say, anybody who doesn't have any household debt and gets this cash injection has to buy corporate shares, but those corporate shares have to be newly issued shares, not existing ones, and they have to be used to reduce corporate debt.
But these the problem is maybe it's not a problem, but these newly issued shares or stocks, these are from the same company.
Yep.
So these will devalue.
Yep.
And at first, then you will feel yourself more rich because you have more shares and more stocks. But as more and more people buy it, and I don't know how long it will go, this program, but just imagine as a process, then the price of these shares will be more and more. So
no, in fact, the share prices have already been driven up. If you take a look at the
why not?
Because the prices of shares have already been driven up by two other factors. The most important one over the long term being that margin lending actually drives up share prices. So we have an enormous amount of debt that's already driven house prices high. If you pay that debt, share prices high. If you pay that debt down, you will also reduce those share prices.
Yes. Okay.
And equally, if you convert the capital base of companies from predominantly debt to predominantly equity, you again improve the financial viability of those companies.
Yes.
So I think all these changes could make companies more viable than they are right now. And it would actually, because you're reducing the leverage on shares, you could also reduce the prices of shares at the same time.
That's very interesting what you say. Yeah, I'm quite curious if this would work like that, but it's also that it's human behavior, so it should be really a well thought process, because And can it work that we just simply don't pay back the debt?
Well, this is one.
Partially at least.
Well, see, but what you have to look at what debt actually represents. It's the claim of the financial sector on the rest of the economy. And because we've let this debt get very, very high, the financial sector has an enormous claim on the rest of the economy.
Yes.
And the financial sector is also, because we've been persuaded that debt's a good idea, the financial sector is maybe 2, maybe 4 times as big as it should be to actually provide what is needed for the real economy. So we have an enormous need to reduce the power of the financial sector and reduce the size of it. It hasn't benefited the economy at all. It's just inflated asset prices and caused more volatility in the underlying economy without providing much in the way of finance for entrepreneurs or finance for existing corporations. So we simply have to identify what the main problem in the economy is. It's because the finance sector is too big. And it's too big because of too much debt.
And if you don't pay back the debt...
If you don't pay the debt back,
will shrink.
If you don't pay the debt back, you finally go bankrupt. Or what you have is an economy where the debt just continues to accumulate. And you have more and more of a debt drain on the economy. More and more stagnation.
Yeah. And are we now in depression or stagnation?
Yeah, I call it
now.
Yeah, I call it credit stagnation.
Yeah, because we don't grow fast enough. We don't grow enough compared to how much debt we have and issue every year.
Yeah.
Right?
Yeah.
Okay. No, nice. There is something else on my list if we still have some time.
Yeah.
It's the green QE, because I read a paper on the IMF website, the blog. One idea could be that the government would issue a lot of money in a certain period of time, and maybe this tap of money would be never closed, and they give this money to the banks because it is best when this money is not distributed centrally, but they distribute it through the banks, and the banks could make funds from these. And these funds would buy corporate issued bonds, and the corporations, the companies, they would use this money to create more green technologies and to lower the carbon footprint. And so the idea is to save the planet, but it's on the surface only. But the real reason to do this is to save the financial system, because then we can push this further, and then we can push money to the corporate sector, and then they could reduce the debt also. Could this work?
Yeah, that's that's what I think is actually going to happen, because a deliberate decision to reduce private debt levels requires, first of all, an understanding that debt is actually a problem.
Yeah.
Secondly, a political situation that means the financial sector can't stop us paying the level of private debt down. Now, I think that's zero chance of the latter, because the financial sector is so politically powerful, and almost zero chance of the former, because we're still dominated by mainstream economists who don't understand this issue. So to get them to make the right decision in the first place is almost impossible. So I think, just like the way we actually got out of the Great Depression, which is also caused by too much debt, was via the war bonds, Second World War. And and the same sort of financing back then that financed the Second World War meant that ultimately government debt levels rose, but private debt levels plunged. And that's why we began the post-war period in America with a very, very low level of private debt, because having financed the war expenditure and rationing private spending at the same time, all you could do was pay your debt down.
Yeah.
And so we began the post-war period with one of the lowest levels of private debt in America's history, not the lowest, but one of the lowest. And that meant you could have a large amount of credit-based demand, getting the stimulus out of credit without the repayment dragging you back down. And that was a major reason why the 50s and 60s are what they call the golden age of capitalism.
And let's hope that now we will not get to a war.
Yeah.
For example, that would be very bad, and that's why we need another solution. For example, I don't know, travel to the Mars. It costs a huge amount of money. It's a good goal, but it's maybe not the best. But climate change and CO2 levels in the air, this could be a good reason.
Well, that's what I think is going to happen, because we, again, just as economists have been wrong about the importance of private debt, climate change economists like Nordhaus are wrong about climate change as well. They've trivialised the dangers of it. When we realise just how serious it is, then it'll just be like the Second World War. Nobody disputed the budget deficit for the UK in 1940.
Because otherwise
they would have been speaking German the next year. And the level of the government debt in deficit in 1940 was 40% of GDP. Now that meant that you could finance an enormous amount of armaments building, of expanding the military, all these dramatic attempts to attack an existential threat. So the same thing will apply with climate change. When we realise it's an existential threat, and it's a much bigger threat than the Nazis,
then we have to.
Then we do whatever is necessary, and then in the process, as a side effect, that will mean that levels of private debt get paid down dramatically. But this is not the way you should manage a capitalist economy, either in an environmental crisis or out of it. We shouldn't have gotten the situation in the first place. Both situations.
But when it will be serious, then it will be easy to sell this idea to the people.
Yeah.
And then job done. Just a matter of time. Knowing all that, how should I, as a young person or somebody who is looking for long-term investments, how would you or how should we invest our money? Because it's very, very difficult to save money now, because we get almost nothing for our money. Also with inflation and with getting lower and lower rates,
people always look for an individual solution to what is a.
So how would you approach this in the long term?
I think the long-term approach is to realise that we've got a dysfunctional monetary system and do something to reform it. It's not a case of individual action. I mean, individual action in this situation like means getting out of debt, for example, which you can do privately, individually.
For sure. But until that you cannot really invest.
But the trouble is, like if the government encourages another asset price bubble on the basis of more private debt, you might miss out on those gains. So it's one of those things where individual behaviour is very, very restricted. We're better off to say, let's get systemic reform and get a monetary system that works. And part of that is not letting private debt get too high and using a government's capacity to reduce private debt, which is a political action, is not an individual action.
And what can we do about that?
Join Positive Money, for example, which is a good lobby group, or similar lobby groups around that are pushing for reform of the monetary system. Join, the things like DM25, something directed at reforming the financial and environmental systems we live in.
Can a crisis be used for that?
Well,
so never let a good crisis just
go
go
to
away.
waste. Yeah. Well, the trouble is, I mean, the last crisis, the 2007-2008 crisis. Only non-orthodox economists like myself were warning about it happening. The neoclassicals had no idea, and they were championing. They were saying how great 2008 was going to be. But when the crisis hit, they were still in charge, and their advice was taken by people like Obama, which is why we rescued the banks rather than rescuing the debtors. It's why the provisions they made to pay down mortgages were barely even used, while they had enormous rescues for Goldman Sachs and things like that. So even a crisis isn't sufficient. Even like the Great Depression, when you look at that, that changed economic thinking. But it only changed it after 1937, because there was a second crisis.
Multiple crises.
We had, first of all, the 1929 crash, and then we had what's called the Roosevelt recession, when Roosevelt was persuaded by his economists to reduce government spending. And that led to the private sector reducing its debt levels again, deleveraging, and unemployment, which had fallen from 25% to 11%, rose back up to 20% again. And then in that situation, basically economists said, we haven't got a clue how the economy works. And Keynes's general theory was published. Here's the solution. And the general theory took over economics, bastardized again by the same neoclassicals, Samuelson and Hicks, who couldn't actually understand Keynes's non-orthodox logic. But it took that second crisis for a revolution to occur, and even the revolution was bastardized. So I'm not convinced that a crisis alone is enough.
It should be more than one crisis, or a very huge one. And here we are today. We still save the banks today and liquidize the market again. Keeping everything above water. Okay.
Okay.
Thank you very much.
Welcome.
It was very nice.
Thank you. Yep.
Good discussion.
It worked okay, I hope.